Well, it's already the last trading day of January, and according to history, this month's performance could make or break the rest of the market's year. No pressure. Markets editor and host of Stocks in Translation, Jared Blikre, joins us now to explain it all. Jared.
Thank you. No pressure. The first month of the brand new quarter century is nearly in the bag. And barring a big surprise today, the world's benchmark stock index, the S&P 500, is going to close green. For investors who pay attention to history, January is a special month as it holds predictive power for the rest of the year. As January goes, so goes the year, said Yale Hirsch in the Stock Trader's Almanac way back in '72. And what Hirsch discovered half a century ago is a prime example of seasonality, or the tendency of markets to repeat certain patterns year after year. In fact, there's a big historical difference in what happens from February to December, depending on how January goes, which we can see in this chart. And let's advance this here, and we can see when we have a negative or actually, let me just say first that this comes from Ryan Dietrich at Carson Group, and then when we have a positive January, they have steady returns on average throughout the rest of the year, with a fat 17% return overall. And that's a pretty big difference for years that start off with a negative January. They lose 2% on average. And yes, those totals happen to include what happened in January. But if you're interested in exactly what happens February to December, we've got that too right here. Again, thank you to Ryan Dietrich. The rest of the year is up 87% of the time with an average gain of 12%. That's for positive Januaries. And that drops to 60% positive and 2% gains for negative Januaries. And that's a statistically significant difference, as the quants say. And for those who are wondering exactly what to buy, let's see what this has been trending this month. And we're going to go to our sector action, and we'll pull up two different time frames here. We'll do last 9 days, and that happens to be the time since the inauguration, and we'll also do year to date. And there's actually quite a bit of overlap between the two. And why the inauguration? Because there was a big dollar reversal that day, and regular viewers might know that I saw some shift changes in the market. But regardless, number one here on our list is communication services. That houses Meta and Alphabet. As I was saying earlier today, it is on a 10-day hot streak along with Meta, and you can see it's up 6.1% over these last 9 days. Second is healthcare. Healthcare is really broken out nicely. I'm going to show you a one-year chart and why I'm excited about the technicals this year. Here we go. From the middle of last year to basically the beginning of this year, it was in a downtrend. It is now broken out, and it has analysts excited too. I've talked to a number of them on Stocks in Translation. And then financials, staples, and consumer discretionary round out these sectors. Now, to the downside, we want to be careful. Energy and utilities have both lost a bit of money. And by the way, tech is almost flat here, as you can see. Just to close, I'll pull up the year to date, and as you can see, everything in the green. The bottom line here for investors is that when we have a positive January, we do tend to have the possibility for nice returns into the end of the year. This is year 3 of a bull market where we've seen the first 2 years up more than 20%, and there are a lot of hopes, and for now they're just hopes, that we'll have another year, a third year of 20+ returns.
Jared Blikre, some high hopes for sure. Appreciate you bringing that one for us.